Hi guys, Jeremy Harper here. Today we're going to talk about fixed versus variable home loans and how that impacts yourself as a borrower. So what are the differences? So a variable home loan is an interest rate which is variable, as the name suggests. So it is in line with the RBA's decision. So as we record this, the RBA made a decision back in February 2025 to cut the central cash rate by 25 points. And what you saw was the majority of the banks, and that's a really good point, the majority of the banks passed that cut on in full. So for borrowers, specific to your specific lender, they announced a date that would be adjusted on your mortgage. So for some, it was say 2 or 3 weeks after the announcement, some pushed out even a little bit further. But once that announcement came through, your variable home loan reduced by 0.25, which reduced the interest rate and it reduced the interest charge on your home loan. So that is in line with what the name says. Important to note, not all banks did this. There was about 3 or 4 lenders that didn't pass the cut on, and some are still thinking about what to do. And so that's within their right. If you read the contract, it does not state that it needs to move in line with the RBA. That's just the market expectation. So if we do continue to go through a rate cutting cycle from here, my guess will be that there'll be a point where some banks, even the larger banks, may not pass on the full RBA cut. So there may be a 25-point cut, and we may see some banks decide to, on that cycle, pass on 20 points. And that's happened previously in previous rate cutting environments. So it's just something to be mindful of as banks are trying to increase their individual margins. They're looking at their portfolio in the background to say, what's their NIM, their net interest margin, or what are they making, what's the margin on the home loan portfolio? And can they afford to pass on full, or do they want to withhold a little bit to try and increase the margin on their portfolio overall? Something to also note that is banks can also increase a variable rate at any stage. So you may get a cut from the RBA. They may make an announcement outside of that to say rates are going up for existing loans, and they'll pass that on. We're not seeing that at the moment, because banks, they don't want to step out of line of market. And of course, if you are sitting on a variable loan, people can shop around to see what else is out there. So if a bank is not passing on the full 25-point cut from an RBA announcement, it means that they're going to have a lot of home loan customers that will take their business elsewhere. And so what's a fixed home loan? So it's a loan that's fixed for a period of time contractually. So you enter in that, and typically it's a 1, 2, 3, 4 or 5 year tenure, but typically the pricing sits at 2 or 3 years, and that rate is locked in for that period. So let's say you settle on a 2-year mortgage that's fixed, that rate is fixed and that repayment is locked in for 2 years. Won't move, even if the RBA makes a cut, even if the bank changes, increases or decreases their fixed rates, you are contractually obligated to repay that loan or stay within that fixed loan for that 2-year period. Once that 2 years is up, that will what you call revert to a variable loan. So let's say you start the loan with a 2-year fixed period, and then you have 28 years left after to revert into. That will roll into standard, a variable loan for that balance of 28 years. You can refix that loan after that point, that's not a problem, but it will go back into a variable, and quite often people will then reassess their options at that point to see what's available. Now, if you look to break your fixed loan early, break costs can apply, which is a calculation background around what was the cost of funding when you entered that fixed loan, what's the cost of funding now, and is there a significant change in that cost to the bank, and they'll try and recoup that back via break cost, also depending on how long you've got left on that fixed loan to go. There's also a rate lock feature, which means that if there's a very sharp fixed rate that you want to hold on to, you can enter into a rate lock agreement with the bank at that stage, and that will guarantee the rate from, say, application to settlement. And let's say that period is 5 weeks between today when the loan's going to settle, and if that 5-week period the bank increases that fixed rate, you'll be locked into that lower fixed rate. And so that's just something that gives people a bit more assurance to say, okay, I'm locking myself into this rate for 2 years. I want to make sure that I settle on that rate, not settle on a rate that's higher. And so who are the variable and home and fixed loans suitable for? Well, so a variable loan, it's suitable for someone that is comfortable to take a risk around fluctuating repayment amounts. So if rates go up, they can pay a higher monthly repayment. If rates go down, their repayment can be adjusted. Now, just to note, some banks will not automatically adjust down the repayment on your mortgage after a rate cut. Either you have to request that, or it may take a 3-month period for the bank to review your interest rate and the repayment amount and to bring that down. Sometimes that automatically happens in the background. But with the variable loan, you've got the flexibility of using offset account. You can pay as much as you want into the loan via just additional repayments. You'll have a redraw function. There's no penalty around that. Versus a fixed loan, you do get the certainty of the repayment, but there will be a cap on the additional repayments you can make into that loan every year. So that's something to be mindful of. For some banks, it may be an additional, say, $10,000 into the loan or $20,000. And so you need to consider that around your goals and what are your objections over the next couple of years with this mortgage, and making sure you're giving yourself that flexibility so that a fixed rate may be cheaper today, but if you can't make additional repayments into it, is that going to cost you more in terms of interest charged in 2 years' time? Or is that going to be acceptable to take that fixed rate, have that certainty, understand exactly what the monthly repayment is, and know that that's not going to move at all during that period? And finally, if you want a bit of each way, if you want your foot in either side of the camp, you can split your loan. So you can have a variable loan, part variable, part fixed. And some borrowers like that. It gives them the certainty of that repayment on say half their mortgage, and the other half they've got variable with an offset account. So they've got all that flexibility that comes with the variable loan as well. So you do have those two options. If you have any questions around that, around your existing mortgage and what's suitable, or if you've got any questions around what may be suitable for you, please reach out to us. Thanks, guys.